An economic bubble is a market phenomenon characterized by surges in asset prices to levels significantly above the fundamental value of that asset. Bubbles are often hard to detect in real time because there is disagreement over the fundamental value of the asset. In simple words, a bubble is an economy that becomes very successful very quickly and which usually fails very suddenly. A bubble is an economic cycle that is characterized by the rapid escalation of market value, particularly in the price of assets. This fast inflation is followed by a quick decrease in value or a contraction that is sometimes referred to as a crash or a bubble burst. How economic bubbles happen? The change of investors' behaviors causes the formation of bubbles in economies, securities, stock markets, and business sectors. Let's look at the five stages of a bubble, defined by economist Hyman Minsky, the first to explain the growth of financial instability and its relationship it has with the economy. The bubble cycle is consistent even though there is variation in the cycle's interpretation. The stages include first, the displacement. This is the first stage when the investor's attention is drawn by a new paradigm such as a product, technology, historically low interest rates. Prices rise slowly at first, following a displacement, but then gain momentum as more and more participants enter the market, setting the stage for the boom phase. During this phase, the asset in question attracts widespread media coverage. Fear of missing out on what could be once in a lifetime opportunity spurs more speculation, drawing an increasing number of investors and traders into the fold. Euphoria. This is a stage of excitement and joy in the market as prices skyrocket. Valuations reach extreme levels during this phase as new valuation measures and metrics are overpromoted to justify the relentless rise. And the greater fool theory, the idea that no matter how prices go, there will always be a market of buyers willing to pay more, plays out everywhere. The next stage is profit taking. This is a stage where investors start to pay attention to warning signs that the bubble is about to burst, so they will start to sell off the assets at high prices and make a profit. However, the warnings of the bubble bursting are difficult to see and notice. Finally, panic. In the panic stage, asset prices reverse course and descend as rapidly as they had ascended. Investors and speculators faced with margin calls and plunging values of their holdings now want to liquidate at any price. As supply overwhelms demand, asset prices slide sharply. Theoretically, there is an infinite number of asset bubbles, but in general, asset bubbles can be broken down into four basic categories. Let's see the stock market bubbles. These bubbles can include the overall stock market, exchange traded funds, or equities in a particular field or market sector like internet-based businesses, which fueled the dot-com bubble of the late 1990s. Another category is the asset market bubbles, which involve other industries or sections of the economy outside of the equities market. Real estate is a classic example. Run-ups in currencies, either traditional ones like the US dollar or euro, or cryptocurrencies like Bitcoin or Litecoin, could also fall into this bubble category. Now, credit bubbles. Credit bubbles involve a sudden surge in consumer or business loans, debt instruments, and other forms of credit. Specific examples of assets include corporate bonds or government bonds like US Treasuries, student loans, or mortgages. Finally, commodity bubbles. They involve an increase in the price of traded commodities. These include tangible materials and resources, such as gold, oil, industrial metals, or agricultural crops. Let's see five of the biggest asset bubbles in history, three of which have occurred since the late 1980s. Tulip mania is one of the earliest recorded instances of an irrational asset bubble. Tulip lands obtained from the Ottoman Empire was an exotic possession used as a status symbol by Dutch high society. By the 1630s, tulip prices escalated, leading a lot of speculators to buy them and later sell at very high prices. Eventually, prices imploded, bankrupting a huge number of speculators and throwing the Netherlands in an economic depression. During tulip mania, the average price of a single flower exceeded the annual income of a skilled worker and cost more than some houses at the time. The South Sea Bubble. The South Sea Company was formed in 1711 and was promised a monopoly by the British government on all trade with the Spanish colonies of South America. Expecting a repeat of the success of the East India Company, which provided England a flourishing trade with India, investors snapped up shares of the South Sea Company. as its directors circulated tall tales of unimaginable riches in the South Seas, present-day South America. Shares of the company surged more than eightfold in 1720, from £125 in January to £950 in July, before collapsing in subsequent months and causing a severe economic crisis. Japan's real estate and stock market bubble of 1985. In the 1980s, the value of yen surged by 50%. This triggered an era of the recession in 1986. To counter this, the Japanese government started financial programs offering monetary and fiscal benefits. These measures, in turn, encouraged unchecked speculations, resulting in the skyrocketing of the country's stocks and land values between 1985 and 1999. The bubble finally burst in early 1990s, setting the stage for Japan's subsequent years of price deflation and stagnant economic growth, known as the Lost Decade. The dot-com bubble. When it comes to sheer scale and size, few bubbles match the dot-com bubble of the 1990s. At the time, the increasing popularity of the internet triggered a massive wave of speculation in new economy businesses. As a result, hundreds of dot-com companies achieved multi-billion dollars valuations as soon as they went public. The profits were not correspondingly high. Nasdaq index showed astronomical profits by March 2000 before plummeting. The index crashed shortly thereafter, plunging 78% by October 2002 and triggering a US recession. The next time the index reached a new high was in 2015, more than 15 years after its previous peak. The US housing bubble. Some experts believe that the bursting of the Nasdaq.com bubble led US investors to pile into real estate due to the mistaken belief that real estate is a safer asset class. While US house prices nearly doubled from 1996 to 2006, two-thirds of that increase occurred from 2002 to 2006, according to a report from the US Bureau of Labor Statistics. Even as house prices were increasing at a record pace, there were mounting signs of an unsustainable, frenzy-rampant mortgage fraud, condo flipping, houses being bought by subprime borrowers, etc. US housing prices peaked in 2006 and then commenced a slide that resulted in the average US house losing one-third of its value by 2009. The US housing boom and bust and the ripple effects it had on mortgage-backed securities resulted in a global economic contraction that was the biggest since the 1930s depression. So what is the bottom line? Although every bubble is different, speculative bubbles in some assets are inevitable in a free market economy. However, becoming familiar with the steps involved in bubble formation might help you to spot the next one and avoid becoming an unwitting participant in it. Thank you for watching. If you like my content, please subscribe, and I will see you on the next one.
Created using Powtoon.